afternoon. Episode 80 of Uncommoncents. Dean Holmes here with his special guest star, Michael Jaeger. Good afternoon, mate. How you going?
G'day, Dean. Thanks. How are you?
Excellent. Thank you. Michael, we were getting started with a little bit of our history of where we crossed paths, and you were talking about where you first started, which was doing some cold calling at your first company.
That's right, yeah. Late 90s, 97, 98, 99, and generally an insurance focus that morphed into financial planning, but very interesting part of the industry at that point in time.
Yeah, absolutely. And then you met Andrew Rocks, and then when we crossed paths, you were coming in and training us young, aspiring financial advisors to have great conversations with clients first and foremost. You weren't training us on products, but actually just how to be humans and talk to clients. And I definitely, although I wasn't at announcer for too long, I learned a couple of skills there that I still take forward today. And one of those is that I was not good at cold calling off competition entry forms. I know Roxy will be watching. So that was how I got started in FB. And yeah, that was something that you and Roxy did a few years earlier. But today we're talking about where you are today at Gen Life, Michael. And we want to get into a little bit of detail about investment bonds or insurance bonds. I think everyone uses two different names, so we'll clear that up as we go through today. But tell us a little bit about where Gen Life is today and your journey with them. And then we'll jump in the technical side.
Sure. I joined Gen Life a bit over 6 years ago, and prior to that I'd been with groups like AMP, earlier still Challenger. So always on the product distribution sales side. The thing that really drew me to the Gen Life opportunity was how strategy focused. And Roxy and I have talked about this in the past, about working for a category killer. And I just got the sense that what Gen Life was working on and what they've actually done since I've been there was really true to that category killer status.
Yep.
So yeah, look, the huge growth in the company, wonderful leadership, and really benefiting from those regulatory tailwinds that came out of some changes in 2017. And now we have things like the Division 296 and a potential revisit to the trusts and how they're taxed. We're in a really unique spot at the moment. All's good at Gen Life.
Yeah, awesome. And we'll talk a little bit about the uniqueness of the laws and where you sit and play in relation to the market for Gen Life. Quick one, am I going to say investment bonds or insurance bonds, or does it matter?
Technically, we're a life policy investment only. We operate under the Life Act, but investment bond is the term. If you go back far enough, you had friendly society bonds, you had insurance bonds, some subtle differences which changed in the 80s and forward. But today, investment bonds is the vernacular.
Yep, absolutely. So that's great. So one of the things that whenever you run into an advisor in the street and you're really interested in investment bonds, all they seem to quote is the 125% rule and how inflexible they think that is. So I want to clear up a couple of these myths first and foremost, and then get into some of the strategies as we go through. Investment bonds are really flexible. Tell us a little bit about how you can put money in, you can take money out, you can breach the rules, you don't have to worry about the rules. Just break some of those myths down about what advisors may have thought about the products in the past.
Sure. So our mantra has always been that after superannuation, certainly up to the 2 million mark, possibly the $3 million mark, depending on legislation, that super remains the most tax effective. We are the next most tax effective environment for anyone earning $45,000 or more of assessable as a general rule, but we are the most flexible structure. So we don't have that CIS overlay, we're not preserved. And the flexibility comes around things like the ability to transfer ownership. And some of that flexibility really didn't exist in the past at a product level, but the Life Act has always been very generous. And today, if you look at the peer group, we don't have those imposts at a product level, minimum requirements and restrictions, and that was all product based.
Yeah. Okay.
So we're then just left with the flexibility. So it's a completely different landscape.
Excellent. And so that means we can obviously put unlimited amounts in the first year. Within the same bond, you're obviously restricted to 125 in the following year. But I talk to advisors about you can just start another bond
Yes.
You can withdraw and recontribute in order to meet the rules if you didn't have money at year 6, for example. And the tax implications, what I think the way I would simply explain it is it's if you had to withdraw the money early, it's no worse than if you had just invested the money in your own name.
That's right. And look, the first thing is superannuation has a cap, a total cap.
Yep.
Both in terms of transfer, balance, contributions. We don't have a cap. So there is no cap per se. You can open up a bond with as much money as you like. You can continue to open up investment bonds. There's no cap. And it's not really, I don't like to think of it, the 125% as a rule. You can break it. It's a framework. It's a framework. And it's simply an opportunity where you have the ability, but not the obligation, to contribute up to 125% of the prior year.
Yep.
Now, if you don't do it, nothing turns on it. We won't let an investor actually breach that 125% level unless they want to, and there are reasons why you may be okay. But we always check back before we process an application that would go over that 125%.
Yep.
So there's actually no issue. It's interesting, sometimes advisors will say, oh, it's such a restriction. And no one has ever shown me an example of where they're contributing at that 125% level outside of the bond.
Yeah, correct. It's a rule that's becomes irrelevant. Yeah, you're right. Superannuation, we're putting $30,000 a year in, and that $30,000 doesn't change year after year. Why should we worry as much? So absolutely. So let's talk about some practical applications of it, and then we can get into the rules about how we use this. And the one that I want to start with is just this discretionary trust, or advisors that open up a discretionary trust to invest in just shares. So we'll keep it relatively simple. And so the challenge that I have with that situation is that I think the tax outcomes of investing in a bond compounded can be better than using a discretionary trust and distributing the money to people and dealing with that complexity. So can you just contrast the two, and let's have a chat about why we think the bond can be a better outcome?
Sure. And I might introduce a third option there.
Yeah.
And it doesn't have to be either or. So really you have using the trust and then the trust having direct investments. You have that compared to using a bond.
Yep.
Or multiple bonds. Or you can use the bond within the trust.
True.
And so really it comes down to, is there value in having the trust in the first place? Now, it might be an existing structure. So you simply want to make use of it because there are other investments. The accountant might be in the conversation, so you want to keep them on side. You might have a desire for direct property and things that you can't do inside an investment bond as a longer term proposition. So that's the first question. Is there merit in having a trust or keeping a trust? And that depends on a range of factors. If you just have a clean sheet of paper and you have a lump of money and there's no value in the trust outside of what you can achieve anyway with the investment bond, then the investment bond provides a simpler, more cost-effective outcome with no detriment. In fact, the investment bond is actually more creditor protected than the trust, insofar as if it's set up properly, the capital in the trust can be protected. But once you take money out, it's up for grabs. Whereas with an investment bond, not only is the capital protected, but withdrawals are protected.
Under the
Bankruptcy Act 1162D. So there's actually an additional, and that's if it's held by an individual, the bond, and it extends to your spouse, that protection. So that's really more the question, but here's the flexibility side of it. We're seeing a lot of cases where there's an additional amount of capital. Maybe it's been taken out of super because of super death benefits tax. Maybe it's an inheritance, but they've got capital. Now, if you contribute that into the trust that's already existing and you have other investments, and then you invest that new capital, you're creating more distributable income to have to manage.
Yes.
And that's when people they end up using a bucket company as a default short-term strategy of deferral that doesn't really get you very far in the long term, depending on your circumstances. So that's the issue that we see. Now, if that same capital was contributed into the trust, but then within the trust placed into investment bonds, you manage your distributable income because the bond doesn't create any taxable event year to year unless you choose to make a withdrawal.
Yep.
So you retain the option to access the bond, but you can now open up some new layers because we had a case where $6 million of fresh capital went into an existing trust. So that was step one. Step two was, okay, but what's happening longer term with this trust and what's the succession plan? And this client has 3 adult children. So the next step was, let's set up 3 $2 million bonds.
Yep.
So now you're segmenting capital to, in the future, be in a position to support the different children and their families through selective withdrawals and distributions, which can then meet their differing needs and the sequencing of those needs. Because without that segmentation of capital and without that managing distributable income, you're left in a situation where you've just got all this income. Now, if those adult children are all on high marginal rates, they don't want to receive a distribution. That's why it ends up in the bucket company.
Yep.
Now, if there was no trust and you just had the $6 million, then you could just set the 3 $2 million bonds up owned by the primary client. So the trust really doesn't matter in terms of the outcome. It really depends on who's in the conversation, what are some other factors. So that's why it's not an either or proposition.
Very good. And one of the things that catch us out at 30 June is the distributable income from investments. So it's very hard for us to, when we do our family trusts minute at the end of the financial year, to distribute money to people. It's actually very hard for us to work out what the income's going to be because the managed funds that we may have invested in haven't worked it out yet. And so the catch is that we might have too much income coming, too much taxable income, and you have no flexibility around that. Whereas with the bond, if I wanted $50,000 worth of assessable income, can I ask you for that, Michael?
Yeah, we can calculate that. So this is what's interesting. This is where the flexibility comes in. So if you just have direct investments in a trust, and let's say typically you'll stream around 230 if there's no other income for a beneficiary, and that'll get them to that 30% average. A little bit at the top rate, but the average will be 30. And then if you do that for every available beneficiary, if there's anything above, that goes to the bucket company. Now, let's call it $230,000. If you had an investment bond within the trust, if you withdraw $230,000, and that could be in monthly segments or in lump sum, and then you distribute that, there'll only be a small assessable component, which will get a 30% tax offset. So for the same gross cash flow, you'll pay far less tax. Or you can work out what's the net number you want, and it's a smaller withdrawal to get to the same after-tax number, which leaves more capital still in the bond inside the trust. So there are 2 ways you can approach it, but the flexibility is with the bond, you can start, stop, increase or decrease the withdrawal. It's always optional, whereas the direct investments will always give you the distributions and create the tax events.
Absolutely. Most people think this 10 years, which we'll get up to, but during the period, if you give me $1 from my bond, there's a component of that is return of my own capital, and there's a component of it that's income with a franking credit. Is that
with a tax offset? Yeah. So with investment bonds, there are 3 parts to the tax conversation. There's the tax internal, and that's that whole tax optimization narrative. Then there's the tax on withdrawals, and that has 2 parts. After 10 years, where there is no assessable component of a withdrawal, that's tax paid, we continue to pay tax internally as the tax-paying entity. And then there's how are withdrawals treated in the first 10 years. And that's probably the least understood segment of that conversation. And that's dealt with by Section 26AH of the Tax Act, and specifically there's tax ruling IT 2346, which provides a formula, and you apply that formula to the withdrawal and it will give you the components. So an advisor can ring us up and say, look, this client's thinking of making a withdrawal of X from this bond. Can you provide us with a calculation? And we'll do that as at the close of business the previous day. And if you were to do it, here are the components. So you can make an informed decision as to whether that's the most effective way to access capital if that's what you're doing. So when you make a withdrawal after 10 years, you receive from us a benefit statement. When you make a withdrawal inside of 10 years, you receive a tax statement with the components. Now, the formula, if it's a partial withdrawal, if it's a small withdrawal, typically you end up with a very small assessable component, and any assessable component receives a full 30% tax offset because we've paid tax internally. We pay tax at 30% on our assessable income, which we reduce through our tax optimization, but our tax rate is 30%. And so then advisors would be familiar with, in the supplementary section of the tax return, item 22, it's proceeds of a life policy. There's a section for it.
Okay. Yep.
And so the assessable component goes into that part of the tax return. It gets a 30% tax offset through the tax return process. So depending on your rate, there might be some top-up tax, or it fully meets your tax liability, or you can use it against other income if that's available. Depending
or I can get a tax refund.
It's a use it or lose it in the financial year it's received.
Okay.
So
which is why we'll come to you to do us the calculation. So that, and that's why I misspoke in calling it a franking credit, because a franking credit can be refunded in your tax return. But this offset that we have, it's, as you say, you use it or lose it, but we're trying to optimize this situation such that if I want $100,000 to come out of the bond, and I know that the recipient doesn't have any assessable income, we can work out the right amount to give them so that there's zero additional tax to pay.
Yes, you can be that precise. So that's why it's so flexible. We've seen cases where there will be an unused tax offset based on the numbers from the bond withdrawal, but they will apply that in the broader tax return against rental income.
Yes, okay.
So if you can still use it, you can use it outside of just that basic formula, depending on your own circumstances.
Absolutely. So there's a lot of flexibility, therefore, during this year. Obviously, we know about this, what happens after 10 years. And it's good to see the language between benefit statement, because that's somewhat in the insurance language. You think that's benefit statement tax-free. And then the statement before 10 years is there's an assessment associated with it. You mentioned, and it's something that Jen Life talks a lot about, but this concept of tax optimization.
Yes.
And the headline tax rate that all investment bond companies or life companies have to pay is this 30% tax.
Yes.
But then we talk about how there's certain rules that only you can take advantage of, that no other structure can take advantage of, which lowers the tax rate. Help us understand that.
Sure. And this is something that gets a lot of attention, but to try to put it into an advisor's mindset, when you have a wrap or a self-managed super fund or just an individual, basically dividends, coupons, distributions, all those sources of income flow into, let's call it a working cash account.
Yep.
And from that, you fund your expenses. Very convenient from a cash flow point of view. Not necessarily optimized. Wraps are getting really good at that sort of individual tax management. So that's what people are familiar with, and it's more of a cash flow consideration. As a life company, inside the investment bond, there's no working cash account. Now, we do have cash funds like the Macquarie Treasury Fund and the Term Deposit Fund, but they're funds, they're managed investment schemes. So when we fund expenses inside the investment bond, we're selling tax parcels. Now, this is an institutional paradigm. So we're talking about lots of money coming in, lots of money in these benefit funds. So it's hard for a retail investor to try to construct, how would this work for me with my 200 Commonwealth Bank shares and my tax? It's a different construct. But whenever our benefit fund or a benefit fund on our menu pays the investment management fee to the manager, Gen Life our admin fee for managing all the administration and the tax, funds a switch or a withdrawal or remits tax to the ATO, something is sold.
Yep.
So a little tax parcel sold. Like a managed account, we can apply a HIFO approach, highest in, first out.
Yep.
Now, that said, we do have a deeper protocol. So we won't sell a tax parcel that would break the 45-day holding period for a franking credit, for example. Some managers don't have that discipline. Now, a traditional managed fund has a FIFO approach, first in, first out. So the reason why managed account, let's call it an IDPS or super, still uses that working cash account approach is because they wouldn't sell tax parcels, because if they create a loss, they have to carry that loss forward until they can use it against a future gain. It could be years in the future. So it doesn't make sense. Because we're a life company, we have the unique opportunity out of the 5 tax structures through which you can invest. So you've got personal, company, trust, super, and then Life Act, which is us. We have the unique opportunity to offset capital losses against income. So that has 2 parts to it. When investment managers rebalance or they make investment decisions, there can be a benefit if there's some losses created on reducing our assessable income against which the 30% applies. Now, remember, we get franking credits and all that sort of stuff too. But operationally, we've got daily unit pricing. So we're forever reducing the assessable income against which the 30% applies. So it's a very dynamic but powerful process. So we express that outcome in 2 ways. One, we publish average tax paid rates. It tells you what did the benefit fund pay. Now, you could have a fund that pays 0 simply because 100% of its income was fully franked. So the franking credit perfectly matches the tax liability of the benefit fund at the underlying investment level. So the benefit fund has paid 0 tax. Frank, there's no difference to super and account-based pensions where having that tax rate against, you get cash back. We can get cash back too in some of our benefit funds because we also have the capital tax management, which is that offsetting losses against income. So it's quite a dynamic process.
So this is a big spreadsheet that's obviously doing these calculations.
To get to that second example, so we publish the average tax paid rates, but what we've now started doing, which is very useful for advisors, is just looking at the tax optimized performance data. So we'll show the headline return of the investment option, what it did in our tax environment, what the equivalent portfolio would have delivered for a 47% taxpayer, 39 company. And then we have a final column that takes our admin fee into account. And then, so we publish that. So that gives you the ability to really see what is the difference of having that framework working for you.
Absolutely. And probably the call out is that you're the only structure that's quoting after tax returns. Because if I look at, sometimes you look at what the headline rate is, and that's a gross return. So a particular fund may have done 10%. I look over at yours and you might have done 7, just thinking 30% tax, but that's not a fair comparison. But with this tax optimization, your 7 is getting closer to 10. And in some of your funds, your return is almost the same as the headline managed fund return.
When some years, some of our funds can have an after-tax return higher than the... And that's because just like your super fund or an account-based pension can end up with being in net tax receipts. Long-term, that's not going to be a main driver, but it does happen. And it's interesting, one would say the individual investor and all these other tax structures, they also receive franking. So if you look at say a 0 for one of our Australian share funds in a particular year, because of the franking, the equivalent rate for a 47% taxpayer would be 24.28%, which is the grossing up rate of the franking. That's really the comparison. So we are an after-tax environment. Everything we do is after tax. When you look at those fund manager websites, they're measuring a pool of money. So it's not even the client experience, it's the pool. And they're quoting returns post fees, but pre-tax. All of ours is post-tax net of fees.
Absolutely. And so, Michael, the last question I have on this tax optimization is this idea that can you, not we, but can you sell parcels on purpose to trigger capital losses?
Okay, so there's an important distinction here that investment managers make all the investment decisions. Okay, in our tax optimized suite, that's done via a mandate. So our benefit funds actually hold the underlying securities, or in the case of, say, a Vanguard, the underlying indices that make up the portfolio. That gives us more scope to use tax parcels, but the investment managers make all the investment decisions. Ours is simply the role of implementing, optimizing that implementation in terms of selecting tax parcels, having the discipline of things like that 45-day holding period for franking credits to work out for this transaction, what is the best tax parcel or tax parcel to sell in this case.
Okay, understood. But the volume of money is that if you thought that every single client of GenLife put more money in each year, you're constantly getting new acquisition of shares at higher and higher cost bases, which means that you'll always sell those in the future to minimize tax.
Yeah, so you have the individual tax experience is the units they hold in the benefit fund.
Yep.
Excuse me, at the purchase price, relevant purchase prices. And our unit pricing, you will always pay any tax bill you need to, taking money out. And if you buy a unit, you never inherit someone else's tax liability.
Okay. Yep. Understood. Okay, so let's move on from the tax side. I'd love to just spend a little bit of time on the estate planning. And this is all about, so there's two things. It's all about trying to do estate planning before someone passes away. I think that this is a great opportunity. Obviously, we've got baby boomers wanting to consider how they transfer wealth to the next generation well in advance and talk or plan for it in advance. So this is what I want to talk about is how we can transfer bonds on death to other people, or we can be setting them up so they're the beneficiary today and actually gifting them money, but not yet giving it to them.
Yeah, so this comes down to that flexibility question too, in that estate planning or wealth transfer is always, it's about right money going to the right parties at the right time in a controlled, protected, tax-effective manner. And what we're seeing is there's an expression, you can give me a gift with a cold hand or a warm hand. And more wealthier clients are saying, when I pass away, all this money's going to flow through, money that I don't need right now. Is there a way that I can bring forward the transfer of maybe some of my wealth where I can enjoy that outcome by seeing the impact that has on my children or grandchildren? Maybe there's a degree of control that still needs to be exercised, which our structure provides that option through a co-signatory function or just placing restrictions on how money's accessed by the new owner.
Yep.
So it provides a lot more flexibility and more dynamics in that later period of life around that transfer of wealth. It's not just a drop dead scenario where, okay, now things happen. And of course, this can all be done outside of that will and probate process.
Before or at death. And so if we think about that, so we've got a client that's gone into a bond, so it's in their name when they die because they're the life insured, the ownership can automatically transfer to the beneficiary. And that means they're still protected in the same way from the bankruptcy asset protection kind of components.
Yes.
And you can also put restrictions on how much income they can get ruling from the grave.
That's right. So you can set up restrictions around when they can access capital. Maybe it's a prescribed income for a period or forever.
Yep.
You might have a co-signatory function where someone else needs to approve withdrawals. So it really depends on the strategy and the circumstance. One of the things we recently introduced was a corporate co-signatory option so that the corporate trustee of a family trust could perform that role. The reason why we've introduced that, in addition to individual co-signatories, wealthier clients and even some family offices that are now in the discussion are saying we need something that's enduring beyond a couple of individuals.
Yep.
So that corporate function was an interesting addition.
Absolutely. So that means that you can still control it somewhat after death. Now, in New South Wales, we have this notional estate concept, which, to simplify from my perspective, brings in assets that we might have given away before our death. So tell us a little bit about what you know of it and how should advisors be concerned around the use of bonds in New South Wales with the view of distributing wealth, but then getting potentially caught up with this?
Yeah, great question. This relates to the Succession Act 2006, and Bob Carr's government introduced the notional estate overlay. And basically, it's not an investment bond discussion. It's any financial transaction entered into in the 3 years of the death of an individual could potentially be examined and potentially clawed back in as notional estate. Now, an eligible person would need to establish that they've been denied a benefit they otherwise should have received, but for that financial transaction. So the first thing is plan ahead. And look, this relates to trust, superannuation, the whole thing. Plan ahead. And if you're outside that 3 years, I have to worry about that notional estate overlay. But that said, there can still be value in using investment bonds, even if they end up being within that window. When you list the assets of an estate with the Supreme Court, they're not an asset of the estate because they are a non-estate asset if they've been set up like that.
Yep.
So there's still value in terms of making it more difficult for a party to have visibility on it. There's a lot of discretion in how these things can be set up, and it can come down to a process of discovery. It's worth saying, Dean, that with family breakdowns, the bonds don't offer any relief because they'll always be part of a divisible.
In a family law matter between a husband and wife.
That's right.
Yes,
now, that's important to create that distinction.
Yes.
But where the bonds can be useful in that vertical transfer of wealth. So we had an example where a lady was terminally ill and she had an account-based pension and a family home, and she was worried that her only child, being a daughter, that all that would drop into her balance sheet as she's going through a really messy divorce. And this highlights the collaboration opportunity between the financial planner and estate planning lawyer and an accountant to get the three around the table as appropriate. The lawyer's solution was, let's leave the family home to the granddaughter and you can have a life interest.
Yep.
That solved that bit. It's a simplified version. But with the account-based pension, the money was taken out and put into an investment bond. Now, first of all, it solved a super death benefits tax issue on the taxable component.
Yep.
But moreover, our future event facility allowed for that lady to nominate a date in the future when it would transfer to her daughter. And the date was, they added a couple of years to the timetable of the family court proceedings.
Yes.
Just to make sure it really kicked out. Now, until that transfer happens, there's no present entitlement in terms of the daughter. Now, it has to be set up properly. So when you set up the future event transfer, it says, would you like to nominate a future date? Yes. If you die prior to that future date, would you like to bring forward the transfer? Yes or no?
And
No.
you said no. Yeah.
In this case, no. And then it says, if the answer is no, would you like your LPR to be able to operate the investment? No, because that's also the daughter.
Okay. Yep. So who looks after the money then?
So that bond remains invested. We're the life company. We're managing it. And then we'll fulfill that transfer as nominated on that date. So it shows you the value of advice. And, the advisor is the one keeping the communication going and liaising with the daughter, etc. But it's a simplified expression of a more complicated scenario, but a very powerful outcome for that client.
That was money that was coming down the line.
Vertical.
Was going to be included in the maritable assets, obviously, because it was capital at that particular point in time. So we've managed to push it forward in that regard.
And there's no issue with notional estate in that case because the husband's not an eligible person in terms of the mother.
And just the final thing about this notional estate is that you hinted, if I'm right, that the person wanting to make the claim has to actually know of the bond's existence because it's not on the Supreme Court probate list of assets. So they have to know it exists, which they can find out theoretically. But the second thing I understand they have to do is they have to fund the legal challenge themselves.
Yeah, we've never seen an investment bond unwound because of the Power of the Life Act. What you could have, just theoretically, is, let's say there was a disproportionate distribution so that there was an investment bond and then it was 50-50 for two other parties. And the party who didn't get the investment bond was unhappy about it and saying, I should be getting 50% of it. That bond won't be unwound. Notional estate, it could be pulled in, but let's say it was set up 5 years ago. There is the prospect that a family provision application might result in a different outcome of what's left because of the presence of that bond.
Understood.
So that's where the discretion is quite useful. And where we see that in practice is 3 adult children, one has no children of their own, the other 2 do, and the grandparents would like to leave some money to those grandkids, whereas the adult child with no children is thinking a third, a whole lot.
Yeah.
So the bonds, if they're set up in advance and it's all done nicely, it can be very discreet so that when those 3 adult children are seeing the will,
Mm.
as far as they're seeing in the optics of it, we're getting a third.
Mum or dad gave money beforehand into a structure that directly goes to the grandkids. And obviously the parents of those children will know, but it's not part of the estate.
That's right. Yep. And look, it's just another tool, and it's how it's used in conjunction with trusts, in conjunction with a good drafting of a will and all these other factors. So there really is that collaboration opportunity between the professions, the estate planning lawyer and the financial planner, especially with estate planning.
Indeed. So we're coming to end, Michael. We could probably talk about this for a couple of hours, case studies. Is there anything that we haven't talked about as like a feature of bonds that you want advisors just thinking about as they go forward from today?
The most popular strategy that we have in terms of some of the higher value cases coming through our tech team and that we're seeing implemented is really within trusts managing that distributable income.
Yep.
And the evolution of that is now we're seeing multiple bonds to bring forward that wealth transfer conversation and that mobility as an option. But the whole Div 296 conversation, which may see a lot of capital being taken out of super, that should head for trusts if accountants are involved. And we're saying that's fine. Inside the trust, consider using bonds. So really it's using it with the existing structures is where we're really seeing it gather pace in terms of take up. It's not an either or. We're not the silver bullet. We're not a standalone solution in some cases. Some cases we can be. But it's really just understanding how it fits into the broader mix and can we improve a situation? Can we address problems, solve problems? That's really where we're seeing it.
Amazing. And I think it's good to agree that there's a lot more flexibility in the ins and outs of the using of an investment bond compared to what providers may have done 10 years ago at that side of it. So I think that's a really valuable conversation to get advisors refocused on this area, that there is actually an ability to use these products within the structures that they have today. Only trusts, not self-managed super funds or companies, but you can talk to Michael later why you would less likely do it in a company. But that's been awesome, Michael. Thank you so much for joining us today and having that conversation. Obviously, you can reach out to Michael and have a continued conversation, but there are a large number of high net worth strategies that we can do, both from asset protection, estate planning strategies, in order to make sure that capital that your clients have built up, your elderly clients have built up over the years, goes to that next generation in a really tax effective and protected manner to protect this asset for the next generation and hopefully beyond.
Indeed. Appreciate the opportunity.
Cool. Thanks, Michael. Enjoy the rest of your day.
Thanks, Dean. All the best.
Thanks, everyone. We'll see you at the next episode. Have a great day.